So welcome back, everybody, to another webinar organized by Princeton for everybody worldwide. We're very happy to have Barry Eichengreen with us today. Hi, Barry. Barry will talk about his new book, In Defense of Public Debt, which just came out recently. And we will hear all the defense to have public debt in the marketplace and for society around the big advantages from public debt. Now, before we go to Barry, I would like to give a few opening remarks on the public debt issues and address the questions a little bit. How much government debt can the market really absorb? Is there a debt buffer curve? And that has, of course, connections to debt sustainability analysis, which the IMF conducts for many countries and is typically very important. Or can governments even run a deficit forever and run a so-called Ponzi scheme? That's in particular the case if the growth rate of the economy is higher than the risk-free rate the government has to pay on the interest rate. And there are all this in the literature. There's all these debt valuation puzzles out there. Recent work by Zhang, Hannah Lustig, Steen van Nieuwenburg, and so forth have shown actually that the US government debt is surprisingly valuable compared to the promises it makes down the road. And that's also true for Japanese debt. And in other words, essentially the interest rate is too low. And recent work by my colleague, Jonathan Payne and others, by Tom Sargent and George Hall have actually derived a new method to calculate the interest rate for the whole yield curve, essentially, for the US history starting from independence almost. And you see the real interest rate, which is given by the black line here, that's the estimated real interest rate across the centuries. And you can see that actually came down significantly in the recent decades. Of course, there's also a total trend for coming back. That's a very careful analysis of doing interest rate analysis using different bonds. And of course, there's some periods where there are no bonds outstanding, but Andrew Jackson paid off all the bonds. But it's a careful analysis to measure the real interest rate for US government debt. Now, the question is a little bit, why is it the case that the real interest rate is so low for government debt? And that's, of course, the case which we have talked earlier, that if you hold a government bond, you not only get the interest payment in terms of cash flow, you also get some service flows. And the service flows can take different forms. One is that it's a safe asset. So what's a safe asset? A safe asset is an asset which you can use for precautionary savings. When you are hit by a negative shock, you can sell it and pay your health bill or pay your buy a new car when your car breaks down. So it allows people, even though they are in COVID markets with respect to idiosyncratic risk, it allows them to insure against idiosyncratic risk. So this retrading and being able to retrade the asset very easily with a low bid-ask spread makes this a very good safe asset, a good vehicle to do precautionary savings. And that gives you some service flow, which is very attractive. So you don't need to have such a high cash flow in terms of interest rate. And that pushes then the interest rate potentially below the growth rate of the economy, which allows then to run some sort of Ponzi scheme. And everybody is benefiting from that. Another form of service flow, which is often referred to convenience yield as well, as government bonds are very good collateral. So they relax some collateral constraint if you want to borrow something. And of course, if you narrow it down, go from government debt into money, reserves, and cash, then of course, money is a particular safe asset. It has actually all of the feature that it relaxes the double coincidence of wants constraint. So we can use it as a medium of exchange. It gives you an additional convenience yield, or it's a particular service flow. So all of that actually makes it more likely, and that raises the question, given that, is it so attractive? Can we just issue enough debt as we want? And what Sebastian Merkel, Yuli Sannikov, and I have shown, actually not. So there's a debt Laffer curve. It's very different from MMT. So there is some limit. So you can actually, these benefits you have from government debt, you can benefit from that, and you can issue new bonds. But if you issue new bonds, you essentially tax this precautionary savings, the self-insurance trading. So it's like a tax rate. But if you issue too many bonds, it's like you erode the tax base. So the optimal thing is you have to have the total benefit for the government is the tax rate times the tax base. Like in a standard Laffer curve, you have the same phenomenon here as well. And what we derive and we calibrate, you get about 2% of GDP at most if you have the optimized way of issuing government debt in the steady state. What's important is this benefit is where this exorbitant privilege is large. It's particularly large if you have this flight to safety feature. Whenever you go in a recession, idiosyncratic risk goes up. People want to hold more safe assets at that time, exactly when the recession is high. And that makes it easy for the government to issue exactly when there's a recession. And that's a very nice benefit to have. And that's essentially what gives us this extra kick. If you don't have this flight to safety feature, then the benefits are tiny compared to what the flight to safety element has. Now, the next thing I would like to relate it to something I was thinking quite a lot recently about this resilience. And the question is, how resilient is debt? Okay, and so I contrasted a little bit with equity and debt. So I have some debt contract here, which pays the same amount independently what the tax revenue of the government is. So that is fairly, the payoff is, but if you get into a difficult region, then you have the problem that there's some default cost. So that's why they have put in some default cost here. And then it becomes suddenly off. So it's a little bit like in my book, I compare robustness versus resilience. Robustness is like the oak, it's very robust, it stands in the wind and it's always very solid. And that is like this, it's always very solid. It doesn't move around with the tax revenue a lot. It can be very solid, but there's of course, when the oak falls, it can't bounce back. And equity is constantly volatile. If I draw an analogy, equity moves around like the reed, so it's more resilient, so it bounces, but it also doesn't have this region where it actually falls off the cliff and can't bounce back. So that's another way to see it, and that's, of course, having this flat region makes debt informationally sensitive in this region, and that makes it a good precautionary savings tool again. So that's a nice feature of that, and that's why the interest rate burden is relatively low compared to issuing other types of assets. So with this, I would like to go to the poll question for your answers. And just summarizing quickly, are you thinking that if you look at the US public debt projections, if you look forward, it goes, you're above 100% now, debt to GDP going, up to 200%, is this sustainable or not? And people in the audience, mostly economists, they say 50-50, roughly 50-50. And then we have the next question, which is, are countries now more vulnerable to sovereign debt crisis after the COVID? So after COVID, everybody's sovereign debt level went up a lot for the US, for Europe, for emerging economies, and for Asia as well. And actually the answer is it more vulnerable? Actually, majority thinks yes, 70%, I think, and then about 30% no, either. But it's not really more vulnerable, because what really matters is the relative debt level. You have to fly into some safe asset, and Jason Furman called it the least ugly horse phenomenon. So you only have to be the least ugly one. You don't have to be beautiful in a sense. And that would be a reason why we don't think there's more vulnerability. And others think, if you look at the debt level, it's misleading because interest rate is so low. The debt burden is very low. That might be another reason. About 9 or 10% think this way. A third question was, central banks, should they be very involved in public debt management, or should they stay out of it and focus on monetary policy? Otherwise, they might undermine the independence. That's about a third thought this way. Then the second answer was, yes, they should be involved to some extent, but only to the extent it involves QE and monetary policy objectives. That's another third. And then historically, we would say they might be involved because some central banks were actually set up to be a debt management office for public debt, if you think of Bank of England and others. So that's about also a third. So it's a roughly third for the third question. So with these, we're looking forward to Barry's presentation of his book, In Defense of Public Debt. And we will hear all the good things about that. And I hope that you will interject some questions in the chat box and Q&A box. Perhaps you think, make Barry defend his position to have a public debt in our economy. Thanks, Barry. It's great to have you. And the floor is yours.
Markus, thank you. This is an impressive institution you've built. The fun part for the presenter is to hear your pre-presentation presentation. Thought the poll was especially useful in that it indicated there was no consensus on any of these questions other than that there will be serious debt management challenges for many countries going forward. The title on this slide is the unprovocative version. The more provocative version is here, and I should emphasize that the book is co-authored with Asma El-Ghanani, who's at the IMF, Rui Esteves, who's at the Graduate Institute in Geneva, and Chris Michener, who's at Santa Clara University. We started work on this, I was telling Markus a few moments ago, before COVID, which overtook our efforts, just as it overtook many other aspects of our lives. So I will argue that recent years have seen a sea change in views of public debt. If you're of my age, you'll recall widespread concern in the 1980s and 1990s about government profligacy, fears that public debt was on a dangerously unsustainable path. The Committee for a Responsible Federal Budget in the United States dates from 1981. This national debt clock at Times Square dates from 1989. You will see that this is a historically dated photograph, $10 trillion of US public debt. But that consciousness about that public debt then, which was less than a third in the 1980s, what it is today relative to GDP, both in the US and in Europe. Nonetheless, those worries found themselves into the 1990 US Budget Enforcement Act, found themselves into the Maastricht Treaty, and with its debt and deficit preconditions for entering the Euro area, found themselves into the Stability and Growth Pact. All those measures indicated widespread worry that government spending and debt were dangerously out of control. That consensus was challenged, obviously, by the global financial crisis. In the US, we adopted the Obama stimulus, causing federal government debt in the hands of the public to rise from 36% of GDP in 2008 to 53% of GDP at the end of 2009, levels that were alarming then, but look somewhat quaint today. European countries, which faced the challenge of recapitalizing broken banking systems, several of them saw even larger increases in indebtedness and debt to GDP ratios. But once recovery from the financial crisis was underway, and sometimes even before, governments took a quick right turn back toward austerity, and it was possible to dismiss the events of 2008, 2009 as only a temporary deviation from fiscal orthodoxy. Then, however, came COVID-19, leading governments to run unprecedented deficits, to accumulate unprecedented debts, unprecedented at least in peacetime, and I'll come back to that. The US federal government deficit, as you know, is currently north of 13% of GDP. Debt in the hands of the public is right around 100% of GDP, again in the United States. Germany, of all countries, has abandoned its debt brake in favor of a deficit of 4.2% of GDP in 2020, and a little larger than that, I believe, in 2021. Euro area-wide, the debt to GDP ratio is again in the neighborhood of 100%, just as in the United States at the moment, and far above Maastricht guidelines or levels. And the same thing, or at least something very similar, is true around the world. So I snatched this figure from the IMF's fiscal monitor, and you can see debt to GDP ratios rising in advanced economies and emerging markets, in low-income developing countries alike. Beware the different vertical scales on these different figures. So the three classes look the same. That sameness disguises obviously higher debt ratios in the advanced countries, for example. Superimposed on these figures, not by me, but by the fund, is the interest expense as a share of GDP. And you can see that behaves different than the debt ratio. And it behaves differently somewhat differently across classes of economies, something that we should return to. Before I get there, I want to ask, is this change in attitudes and practices justified, and will this more relaxed attitude last? Justified, clearly, yes. Extraordinary circumstances like those of a global pandemic justify extraordinary action. A government that doesn't respond to this kind of emergency by mobilizing all available resources, including resources that can be mobilized only by issuing debt, will not long retain its legitimacy. Politicians, you will know, tend to reason by way of analogy between the household budget and the government budget, although economists, or at least some economists, have reservations about that analogy. Bear with it and me for a moment. It's argued that just as a responsible household should live within its means, so too should a responsible government. But a government that doesn't borrow in order to provide essential services during a deadly pandemic would be accused of dereliction, exactly like parents who refuse to borrow to obtain life-saving surgery for a child. Indeed, states and rulers have long borrowed to meet emergencies, most obviously wars. Rulers have borrowed to expand the realm, but also to defend it against hostile invaders and to survive. Borrowing to mount a sturdy national defense strengthened the state by successfully repelling invaders, but it also strengthened the state in a political sense, since a state that provided a sturdy national defense and protected residents against hostile invaders gained legitimacy in the eyes of its public. It follows that Europe was the sovereign debt pioneer because war was especially prevalent in Europe with the collapse of the Carolingian Empire in 888. The European continent was divided into hundreds of princely kingdoms, many no more than cities with modest hinterlands. So I show you that political geography circa 1200 on the right. These states were small, they butted up against one another, and that political geography reflected Europe's physical geography as a landmass divided by mountain ranges and river valleys that posed natural obstacles to the formation of more extensive territorial states. So you might contrast this case usefully with that of China, much of which, the Himalayas notwithstanding, is a great plain, allowing a unitary state to be established already in 221 BC, with a uniform written language, a standardized currency, a unitary tax system, and from the outset, a great wall to help protect the empire from invaders from the north. China had, for reasons of geography that contributed to its internal unity, China lacked the same need to borrow to finance warfare. So we do talk about China, Chinese emperors beginning to borrow in the 19th century. We do talk about other parts of the world, but the first part of the book is appropriately Eurocentric because sovereign debt history initially is Eurocentric.
Can I ask you a quick question? There was, of course, with Alexander Hamilton, I think it was James Madison, there was the argument that you should not be able to allow to issue debt as a government because it will just lead to war. So if I turn it around, If you can't issue debt, you can't hire soldiers, you can't fight wars. So is that the cause for wars, to put it provocatively?
Well, governments do try, sovereigns have tried to develop their capacity to borrow in order to mobilize mercenaries to fight wars. Madison, I suppose, viewed the United States as happily insulated from threats from abroad. If you look at this political geography in Europe, you can well imagine many sovereigns that wanted to develop their capacity to borrow in order to fight defensive wars. So I think Madison's argument can be turned around as well.
Okay.
So the problem, of course, being one of commitment by the sovereign. The king or the sovereign was the supreme earthly power, the personification, the embodiment of the state, as Louis XIV reminded his subjects. But that unlimited power limited the sovereign's ability to borrow, since there was nothing to prevent him from reneging on his obligations. Sovereigns could borrow. It followed only for short terms and at relatively high interest rates. So there were political preconditions for the emergence of sovereign debt and modern markets in sovereign debt. We show in the book that sovereign debt began its gradual rise to modern levels only with the creation of representative assemblies in which the creditors sat and were empowered to oversee tax collection, approve increases in spending, authorize issuance. And this process gets underway first in Italian city-states like Florence, Genoa, and Venice, where it was easy to assemble political representatives, including creditors, all in one place. And then in other jurisdictions like the Netherlands and England. And as those representative assemblies were created, real interest rates on sovereign debt began to come down. I show you the case of Holland between 1600 and 1750 on the right, with showing you their real interest rates on sovereign debt. And as part of that process, sovereign debt comes to be recognized as an obligation of the state rather than of the individual occupying the throne. So there were political conditions for the emergence of modern sovereign debt. There were economic preconditions for the emergence of modern markets and sovereign debt. Not only did real interest rates come down, as I showed you in the previous slide, but come the 18th and 19th centuries with industrialization and modern economic growth rates went up as well, meaning that the now familiar R minus G came down as well, making heavier debts more sustainable. So there is a sense in which modern public finance and modern public debt levels are corollaries of modern economic growth. More economic preconditions. In addition, in order to place debt in private hands, there had to be a population of individuals with savings to invest. So unsurprisingly, we see the successful placement of public debt in private hands at the same times and in the same places where commercial activity was expanding. Venice, Genoa, the Netherlands, Britain, which were among the public debt pioneers, were all major commercial and naval powers in their day. And similarly, the French towns that were home to the Champagne fairs, illustrated on the right, were among the first jurisdictions to successfully market municipal and then sovereign bonds to residents. There were financial preconditions for the emergence of modern markets in public debt. Successful issuers had to create secondary markets on which debt securities could be bought and sold, allowing investors to diversify their claims and limit their risks. They had to create an entity, a central bank, to backstop this market and buttress its stability, ensure its liquidity. With important spillovers to private markets, as government debt securities came to be seen as increasingly safe and liquid, they were accepted as collateral for other borrowing and lending. So this was a point that Markus emphasized in his introduction, and in the book we try to trace the development of that safe asset characteristic, which we associate with political checks and balances. And then we try to show how this was associated with the development of markets in private debt, as those markets develop using public debt securities as collateral. Scholars of what is called the Great Divergence sometimes ask why Europe was first. Why was it the first part of the world to experience modern economic growth, sustained economic, financial, and commercial development? So the fact that Europe was first to develop markets in public debt is not the entire story, but we argue it's an important part of that story.
So, Eric, can I say, so you showed this graph that the real interest rate came down, but I guess part of it was the default rate came down too, because there's some work also showing that initially debt was renegotiated between the emperor and Fuggers and other all the time. So to what extent was it really debt, or had it more equity features as well? Because if you can debt renegotiate all the time in an efficient way. Do you touch on this too in the book? Or?
So we do talk about early instances of sovereign debt default, but sovereign default is a historical regularity, and I'm not sure I would subscribe to the view that the incidence of default came down over the period that we have been discussing up to now. The 19th century, which I will come to in a couple of minutes, is a colorful history, a colorful period of sovereign lending and default. But I think understanding why interest rates in Holland, for example, came down over this period, it is partly the construction of political checks and balances that allow creditors to more effectively enforce their rights.
Okay, thanks.
So over time, the uses of public debt have evolved. Financing wars remained of premier importance, and I show you the US case on the right, where the War of 1812, the Civil War, World War I and World War II are highlighted. In the US, World Wars I and II saw the two largest public debt explosions relative to GDP in the 20th century. But governments increasingly also borrowed for other purposes in the 19th century, starting in the 19th century for developmental purposes, to invest in roads, railways, ports, urban lighting, sewers, the infrastructure associated with modern economic growth. And then in the 20th century, I write there in the late 19th century, alluding to Bismarck's Germany, but really in the 20th century for social programs and to finance spending on social programs and transfer payments. So there is a paradox there, of course. Borrowing to finance infrastructure and investment made sense, since the returns accrued to the government over time, and those returns could be used to service the debt. Why transfer payments weren't financed out of current revenues is less obvious. And three elements of the answer we explore are: number one, the tendency for demands for income support and transfer payments to rise precisely when revenues fall in hard economic times. Secondly, political fractionalization. In a fractionalized polity, each political faction has just enough power to defend its preferred social programs, but not enough power to cut spending on the preferred programs of others. Classic collective action problem. And third, political polarization combined with electoral uncertainty. Politicians will advocate more spending on their favored programs when in office, revenue constraints notwithstanding, since they may be in a weaker position to push such spending later when out of office. And the more their preferences differ, the more polarized the polity, the more they will push. Then, of course, came COVID-19, a crisis tantamount to war, and it elicited a classic war-like fiscal response. The question I alluded to earlier is whether this sea change in attitudes and actions will persist. If the change in the fiscal landscape is simply the product of COVID and no more, then maybe the intellectual tide will now go back out. Maybe we should expect the status quo ante, namely old attitudes cautioning against excessive debts, to resurface. Maybe this is what we're now hearing from the moderates in the US Congress. One can argue that the change in attitudes predates COVID-19. There was the experience with premature austerity after the global financial crisis. There was increasing attention to inequality and social fault lines and discussion of what public spending could do about those problems, growing recognition of the need for government to provide public goods, education, healthcare, et cetera, that markets don't always adequately supply. So American historians talk about successive American orders, the New Deal order of bigger government, followed by the neoliberal order of smaller government, and the possibility that we're now swinging back toward the New Deal order as a result of COVID and all of the above. Another factor, of course, is that lower interest rates have made heavier debts more sustainable, other things equal. In the United States, federal government debt service cost only 2% of GDP in 2020, unchanged from 20 years before, when public debt in the hands of the public relative to GDP was barely 1/3 as high. Interest rates on public debt are lower, not just in the US, but across the advanced country world. And here I show you the same for a sample of European countries. The question, of course, being whether these low rates will persist. The answer should depend on why you think interest rates are low at the moment. The high savings of Germany, Saudi Arabia, fast-growing emerging markets such as China, because of growing inequality and the high savings rates of the wealthy, because of the shift from manufacturing to services and from factories to digital platforms, which are less physical investment intensive. Opinions differ. The opinions of the gentleman on the right differ, but we can imagine that some of these factors could now go into reverse. And if interest rates rise, so too will debt burdens. Debt consolidation will become more urgent. Governments will have to worry more about debt dynamics, where the familiar equation governing the evolution of the debt to GDP ratio, shown on the left of the equation, depends on the primary surplus ratio, government budget surplus net of interest payments relative to GDP, on the interest rate growth rate differential interacted with the inherited stock of debt, and on everything else, which we glorify with the term stock flow adjustment, which actually can be quite important in certain times and places, as I will show you momentarily. We put that equation to work in a number of historical cases, in some rather extraordinary historical cases when viewed from a modern standpoint. So this is the public debt ratio and the primary budget surplus as a share of GDP in the United Kingdom from the end of the Napoleonic Wars, 1822 here, up to the eve of World War I. This is really an extraordinary graph, right? Debt to GDP ratio on the order of 200% of GDP that comes down to 30% of GDP on the eve of World War I, courtesy of a government that runs primary surpluses year after year after year for fully a century in order to help bring down this debt. So there's a small deficit there at the time of the Boer Wars, 1901, 1902, but we can put that aside. The Victorians had a philosophy of sound finance that they actually were able to implement. They were worried about future wars with continental Europe, so they wanted to preserve and restore and preserve their ability to borrow again in the event of a future conflict. And the creditors were powerful. In Parliament, there was limited influence of the working class to push for additional public spending, even after the Reform Acts of the 1830s and 1860s.
I was wondering, do you have the numbers with the interest rate for that time period relative to the growth rate of the economy?
Yeah, I'll show you that in a moment, actually. And it turns out that the primary surplus does all the work. The interest rate, growth rate differential does none of the work. And that will be true for the next two cases that I show you as well. So here's the case of the United States from the Civil War. Debt was not initially as high, but it was extinguished by the time of World War I. Again, a courtesy of a government that was able to run persistent primary surpluses of substantial size. Strong creditor influence in government. The populists complained about the bankers and the creditors, but their complaints didn't win electoral favor at the federal level. It was convenient that southern states opposed expansive federal spending, which might have threatened their social order. There was limited military spending prior to the Spanish-American War at the turn of the century. So, here is where many people assume that R minus G did a lot of the work, that the economy was growing rapidly because of immigration and other things. That is not what caused the debt to be extinguished over this period. And finally, the case of France, shorter period of time, but same story. In France, the elite saw new taxes as a necessary evil, as enabling the country to prepare for another possible another war with Germany. So the elites supported higher taxes on themselves in order to put the country in the necessary position. So here, I think, Markus, is the table that you were asking for. So we look at those three cases over those three different periods. We look at the starting debt to GDP ratio and the ending debt to GDP ratio and the decrease in that ratio, first blue arrow. And then we ask, what was the contribution to that decrease? So the three numbers on the right-hand side should add up to 100%. If I'm doing things correct, that's not quite the case. I take that part back. But you can see that the primary balance is doing more than 100% of the work in the UK case, more than 100% of the work in the US case, and just about 100% of the work in the French case. And even in the United States, the growth rate, interest rate differential contributes slightly negatively to debt reduction over the period. And there's this one other number that kind of stands out from the table. So this is Goshen's 1888 debt conversion operation, where, consistent with the bond covenants, he buys back debt that was trading above par because interest rates have come down economy-wide. He's able to reissue at more favorable rates, and that contributed to the debt reduction process as well.
So your hypothesis, essentially, if I understand correctly, is that the threat of a future war brought the debt to GDP ratio down. If I project forward, do we have any threats out there which are similar from a threat of future? Because climate change, for example, is a different form of threat because you have to invest now. You can't just say we are safe now and then we have to invest in 20, 30 years. Is there some other threats out there right now? We say, oh, this should actually bring our debt to GDP ratio down because we have to prepare by bringing the debt level down to be ready to crank it up in the future?
Well, I think it's prudent to think about the problem that way and ask whether climate change is an existential crisis that could be akin to war at some point, whether we have to worry about another pandemic, whether there are certain geopolitical flashpoints that we should be thinking about. I do think that governments have to worry about restoring their capacity to borrow in the event of a big future problem. And I will come to the end of my talk in a couple of minutes, and I talk about exactly that. But before getting there, we also look at some other cases that one wouldn't want to emulate after World War I, when Britain basically did not succeed despite trying hard in bringing down its debt ratio. There was a very difficult political battle to agree on what form of fiscal restraint to implement that led to the fall of the Labour government in 1931, contributed to financial instability, to the collapse of the gold standard, made for slow growth and high interest rates throughout the 1920s. Another case one would not want to emulate, of course, was Germany in the 1920s, where the debt was liquidated through hyperinflation with real costs to the economy, much higher borrowing costs to the German government in the wake of the hyperinflation and liquidation of the debt than seen in the United States or other European countries. And there are some who would argue that that backdrop contributed to what happened politically in the 1930s. After World War II, just a word, debt consolidation after World War II, where there were substantial reductions in debt to GDP ratios in precise periods differ, but this is the third quarter of the 20th century, across the advanced economies, which I look at here. These debt consolidations were not achieved, as sometimes assumed, purely by fast growth and financial repression. Again, there was fiscal effort. Primary surpluses, as I show you, also played a role. The growth rate interest rate differential contributed usefully. There were other problems that showed up in the stock flow adjustment that contributed negatively. So the question then comes, can we exert analogous fiscal effort now through persistent primary surpluses? And I would argue relying on the ability to run primary surpluses alone is problematic. Governments have been able to do this only under very special circumstances. A few years ago, Ugo Panizza and I looked for countries that were able to run primary surpluses as large as 5% of GDP for as long as 10 years. And we were able to find only 3. Norway, in the wake of discovering large amounts of oil and gas in the North Sea and wanting to put that aside for future generations. Belgium, with the highest debt ratio in Europe and desperately seeking admission to the euro area, being forced to bring that debt down, make progress on it anyway in order to qualify for admission. And Singapore, with a strong technocratic government and in a dicey geopolitical part of the world. So they all faced special circumstances and Normal countries don't seem to do that. What about surprise
so
and
all the oil producing countries like Saudi Arabia and all this didn't have primary surpluses? So I don't have the numbers in my head.
I don't have that number offhand.
So you focused on OECD or countries primarily?
No, I think we actually looked more broadly, but I would have to go back and look. What about surprise inflation? So there are people like my friend Charles Goodhart, who argue that debts will be inflated away in part or whole, that we should look forward to inflation rates of 5 or even 10%, and that this will be part of the process of restoring that capacity to borrow. I'm skeptical because I think investors will adjust maturities, so the increase in inflation will have to be very big, or there will have to be repeated surprises. I think stability culture is deeply ingrained in today's central banking community. So there clearly will be a test of my hypothesis going forward, but I don't think significantly higher inflation will contribute importantly to debt reduction. What about
Are you convinced that, coming back to fiscal dominance or financial dominance, that the central banks will have enough political space to, put the brakes on if needed? Or will there be so much political pushback, or also potential financial havoc on the financial markets, that they will be reluctant to really lean against an increase in inflation heavily?
So my presumption, my guess is that central banks, by and large, will be able to push back. A lot depends, of course, on the country you're talking about. I would give you a different answer if you specified the case of the United States versus the case of Turkey. So there will clearly be a range out there, but there are those like Charles who argue that the debtor lobby is very powerful and it's going to push for more help from central banks to ensure debt sustainability. The creditors lobby of investment funds, pension funds, insurance companies is pretty powerful as well. What about faster growth? As after World War II, growing the denominator of the debt to GDP ratio is the painless way of restoring the ability to borrow. So this is what Europe is hoping for with its recovery fund. This is what the Biden administration is hoping for with its infrastructure plan. Maybe COVID has accelerated digitization and we're on the cusp of a period of faster productivity growth. There is no evidence of faster productivity growth yet. What we've seen so far is a shift in the sectoral composition of output and employment away from relatively low wage, low educated workforce sectors, with some shift now back in the other direction. And I think the history of the Industrial Revolution, the internal combustion engine, computerization suggests that productivity growth accelerates in response to new general purpose technologies like digitization, only with a lag of years or even of decades. So I wouldn't necessarily count on faster productivity growth either. All of which is to say that there are no simple solutions. Our conclusion in the book is that countries that have successfully addressed problems of debt sustainability without suffering major economic, financial, and political dislocations have done so by turning to fiscal restraint, by running primary surpluses when the time is right, by growing their economies successfully, and by at least avoiding deflation, maybe even running modest rates of inflation, and that failing to address the problem from all three angles is a recipe for disaster. So on that happy note, thank you.
Thanks a lot, Barry. So perhaps we can raise some more questions which came up in the audience as well. So one thing is, you didn't distinguish who is holding the government debt. It might be held by foreigners, it might be held by domestic citizens with a lot of voting rights, or, as you said, pension funds, which are influential or not influential. Can you say a little bit about the political power, and is it very important to figure out who is holding the debt, or is it independent of that?
No, it's critically important to think about who is holding the debt. As we describe in the book, explicit default is more prevalent, is more likely when the debt is held externally. It's critically important. You know, one of my favorite subjects is the currency denomination of the debt as well. So that is equally important. So there's a lot of nuance there. That's why the book is 200 pages long.
Great. And then there's some questions, you know, climate change triggered some interest. So Stavros Tsenios, he would like to know, isn't it because of climate change we have to borrow even more, and that actually will change our star? And do you see this a problem, that the interest rate is going up because we have to borrow so much just to deal with the climate change challenges? Do you see a problem there too, or do you think, oh, we have to now get the debt level down? Or what's your take on the connection between climate change and government debt levels?
So
you see, oh, let me rephrase it differently, perhaps. Do you think that should be used in a more cyclical way? Whenever there's an urgent crisis, you use it, and then you, like in a Keynesian sense, and whenever it's good times, you pay back? And do you see climate change as the same as a cyclical thing, or more long-run trend?
So I think we are going to be investing in climate change abatement and climate change adaptation for many years to come. It's not a one-time investment now that we can borrow to finance and then we can pay off the associated debt over time. So I think we're going to have to tax finance some of those investments as they extend over a period of years. There are obvious ways of doing that. Can you say carbon tax?
So rather than funding it through debt, you would say, you know, big chunk of it has to be funded through taxing right away, because it's a long-term project.
So it's a question better asked of someone with a second hat as a climate scientist or economist. But this problem of climate change is going to develop probably in unexpected, nonlinear ways. We're going to be dealing with it for many years.
Yes. So there's another question by Robert Owen. He would like to know more about, you know, the ability to fund yourself cheaply depends to a large extent on your currency, the dollar, and for the US, for the dollar. How do you see the interplay of maintaining the dollar as a global currency and issuing a lot of dollar debt? Is it, you know, on the one hand, you need dollar debt as a safe asset, as a reserve asset for many other nations. On the other hand, if you're overly indebted, it might become less attractive as a reserve. So where do you see the interplay between a stable currency on the one hand and, you know, being able to issue a lot of debt?
Yeah, so I think the America's Exorbitant Privilege has some value. I wrote a book once with that title as well. I would observe that the country has retained its exorbitant privilege and the dollar has maintained its global role, and US Treasury securities have retained their safe asset characteristic through periods of considerable dollar volatility, exchange rates going way up and way down, US inflation going way up in the 1970s and then coming back down. The dollar has maintained those characteristics in the face of a global financial crisis that was in large part fomented in the United States in the face of all these debt ceiling histrionics. So, you know, really bad behavior on the part of the political stewards of US debt securities would certainly erode that safe asset characteristic at some point. And the advantage the US has at being able to borrow at somewhat more favorable costs. than otherwise. But what it impresses me, if I look back at half a century of history, is how durable that advantage has been. It survived the Trump years. It's survived a lot of craziness over that period.
So Jeff Shaver would like to know more, perhaps you can elaborate on, budget discipline. So if you can go into that very easily, you don't think hard, is this a wise investment for society or not? You just spend it without, prioritizing well enough. Do you see a level, an interaction there that if it's very hard to issue debt and to spend, your spending will be much more carefully selected? Is there a sense that right now, when R is smaller than G, we can just spend MMT-wise as much as we want, and then you don't think hard anymore what's actually useful spending and what's not useful spending?
Absolutely, I think there is a danger there. So I was not in favor of the December 2020 or March 2021 stimulus packages as structured. As we were coming out of the pandemic, I don't think it was necessary to throw more money at families with a household income of $150,000 a year. And the fact that interest rates have remained as low as they had relieved the Congress in part of having to think hard about whether to keep that ammunition dry and worry more about the future.
Then there's, again, the interplay between issuing debt and the central bank. For John Eatwell, for example, asks, in the last 2 years in the UK, the entirely new debt was just passed on to the Bank of England. So it's not really issued to the market. How do you see that? And, do you think that's problematic down the road? In particular, if you think about if suddenly inflation is picking up and you have to undo these activities, how do you see the interplay more generally between debt management and central banks, their involvement in that, and in connection with QE and what they did at the moment?
So I was hoping to take guidance on that question from your initial poll, where it's clear that the economics community, as represented at Markus Academy, there is no consensus on that question. Clearly, there is an element of moral hazard involved there, but I am strongly supportive of what the Fed, for example, did in 2008, 2009. I think quantitative easing helped on the margin. I think the Fed was quite right to intervene in the Treasury market in the way it did in March of 2020. And it's trying to avoid the associated disruptions by signaling very carefully, very far in advance, so everybody in the market can square their positions as it looks forward to tapering. So there are problems there as well, as we all know, that the more carefully and extensively the Fed signals, the less room it has to adjust its strategies to incoming information. But this is the world we're currently in.
So going beyond the US, of course, everybody has, or each country has a much higher debt to GDP ratio these days. And at some point, it might be necessary to have some debt restructuring coming up. Perhaps you can elaborate on that. What's your take on having, some SDRMs or some debt restructuring mechanism to make it more smooth or something? Do you think the CAC arrangement we have at the moment is sufficient? Does it actually work sufficiently well, or do we have to go institutionally further on that? Or do you think we all will do like England in the 19th century? We will just for 100 years pay off the debt and everything will be fine?
No, I think I could have shown you lots of other figures of cases where sovereigns stopped paying and debts were restructured in one way or another. It has long been my view that a sovereign debt restructuring mechanism is politically not in the cards, that there are important IMF members who would not support the creation of such a mechanism, starting, I hazard, with the US Treasury. So I think we are going to have to lubricate the existing ad hoc machinery and try to make it work a little bit more smoothly, because there are going to be, in developing countries in particular, that still have difficulty borrowing in their own currency, where vaccination rates are so low, so they're going to have difficulty growing. There are going to be serious debt sustainability problems and more restructurings coming down the road. I think the debt suspension initiative that was agreed by the G20, it has a new name now that I can't recall offhand, is insufficient, because it simply appeals to private sector, private creditors to offer comparable treatment without a mechanism to ensure that. I think there are legal steps that can be taken by the executive branch in the United States, in other countries, that can ratchet up the pressure on, or by the United Nations, as it did in the case of Iraq in 2003, that can ratchet up the pressure on private creditors and make the existing machinery work more smoothly. I think that's the only game in town, if you will.
So if you had the power to implement one initiative in the world in order to smooth some debt restructuring, what would you do? Is there any particular thing, or there has to be a menu of many little things?
I think if you give me unlimited power, I would create independent sovereign debt restructuring mechanism. But of course, none of us have, and I would put you in charge of it, Markus, but of course, none of us have that power. So I think we pragmatically have to push this on a number of different fronts. So when the SDRM proposal came out, I started writing about collective action clauses, which actually, because they have a long history, we write about their 19th century origins in the book, and they're now widespread in sovereign debt markets in Europe and elsewhere. I think there are steps to limit the scope for litigation by vulture funds and holdout creditors that I was alluding to a moment ago. I think we have to approach those problems on multiple fronts, and the governments of big countries that borrow in their own currencies and don't have equally severe problems need to exert pressure for disruptive creditors to fully burden share as well.
Very good. So thanks a lot it was a pleasure to have you and to present your book. And I think probably I just whetted the appetite, because there's much more in the book. It's a long book. And then also the discussion at the end shows that the breadth of all this issue, it's a big issue, and it goes back in history a long time. So I thank you. And at the end, we have the tradition. You can always end with a positive note, or you can also say something, what would make the global sovereign debt situation more resilient. If you have any thoughts, some final note on the audience, or what the researchers should work on in this space from a historical perspective or from a modeling perspective, that would be a nice concluding remark.
It would be self-serving to say, please read the book. So I will only say thank you, Markus, and audience.
Thanks a lot. And I recommend everybody to read the book, and hope to see you soon in the real world beyond Zoom. Thank you. Bye-bye.